team. Today we'll be learning about the basics of options market. No matter if you're new to this market or you're new to this options market or you're at an intermediate level, this course will make all your concepts very easier in order to understand. All your concepts will also be strong before you complete this course. So let's not waste our time, get into the learning path. The first topic which we are going to see in this options market is about basics of derivative, because option is a derivative product. So in order to understand about the options, let's understand what is derivative. So derivative is an actual contract or a product, you can assume, which value is derived from the underlying asset. This is the meaning of it. Let's understand with an example. Petrol price, it is derived from which product? All of us know it is derived from crude oil, right? No doubt. So petrol is a derivative, crude oil is an underlying asset. In order to give you one more example, let me assume you have milk. From that milk, you got curd. So milk is an underlying asset, curd is a derivative product. And from that curd, you pour some water. Okay, so now what happens? It becomes buttermilk. So buttermilk is a derivative and curd is an underlying asset. Now what happens? From that buttermilk, I take butter out of it. So now the butter is a derivative and buttermilk is an underlying asset. It is very easy right now, right? You understood the topic? So that was the meaning of derivative. So in financial market, there are many derivative products. Let me give you an example. Reliance future contract value is derived from which underlying asset? All of us know it is from Reliance share. So Reliance future is a derivative product and the underlying asset is Reliance share, right? So in order to give you more examples, you can see the screen. Nifty future, Bank Nifty options, Reliance future, TCS call option, crude oil options, gold future. All these are a product or a contract, you can assume, which value is derived from its underlying asset. I hope now you are very strong in order to understand what is a derivative. You got to know what is a derivative. So let's now see what are the different types of products available in the derivatives market. So derivative products has five types of product. You can assume as in four as well, because two of them are not in trading. Only futures and options are only there in trading. So you have to focus only in two products, because these only two products are there for trading. One is future, one is option. So future requires span margin, options require premium. Now let's understand what is future. Future is a contract which has two parties, one is buyer, another one is seller. So it is derived from the underlying assets which has a price and it has a contract expiry. For example, in our financial market, we have three expiries of every product. One is current month, another one is next month, and another one is next to next month. So three contracts are always available for a trader or an investor to put their money. About that also we will see later, but as of now let's come to this topic. So now we understood what is in future. So what happens, let me assume you bought an gold future contract, but you have buy the future contract, but you have not closed your future contract because you are in a big loss. So what happens in that case? You should not be a defaulter in order to close your position because you are in a big loss. So what happens if at all you don't close your position before the contract expires? Then you have to take the physical delivery of that product. No one has an intention in order to take a physical delivery of any product, right? So all of them take the position in order to close that position also, in order to make profit, because some might make also losses, that is some other criteria, but you don't take delivery, sorry, I mean you don't want to take the delivery of the future contract, right? So the future is actually regulated and organized by an exchange called NSE, National Stock Exchange India. All the transactions which are made in the futures and option, it is everything noted over there. So you have to be very conscious when, if you don't close your position, you have to take the delivery of the product. We will also speak about that, how delivery happens, what is the percentage of amount you have to give in order to take the delivery of the product. So as of now, let's get into the next topic. It is an options. What is an option? Option as also is a contract which has two parties, buyer and seller, and the price value is derived from the underlying asset. It also has a start date, it also has an expiry. But when you're trading into the options market, you don't have to take the delivery of any options, I mean any of product, because if you don't close your position, automatically your exchange, I mean your broker will square off your position before the expiry. So the delivery option is not available in the options market. In this options market, buyer pay the premium and seller receive the premium, right? We will talk about that in a very detailed manner, but as of now, understand what is future and what is option. We will also speak in detail about the futures and in detail about the options also. Okay, so in order to make you understand about the future and the option, let me give you an example over here. In the future and option, there is a contract which has a buyer and a seller plus price plus quantity, which is called a lot size. So every product has a different quantity available in that contract. Okay, and it also has an expiry. There is an expiry for that product. Okay, now you understand what is a contract. Let me give an example within real estate. So let me assume there is person A and person B and person C. Person A is spot market, person B is advance payment, person C is token advance. So when you buy an 1000 square feet of, per square feet rate is 2000 rupees. So the total investment value of that product, I mean that flat, is 20 lakhs rupees. So the person A pays the full margin, he is paying the full amount of the investment required. So 20 lakhs is required and he is paying 20 lakhs. But when it is coming to the person B, he is paying an advance amount. So the advance amount, like when you're buying a flat, what you do, you say the seller that I will pay you only 4 lakhs right now, rest of the amount I will pay you after 3 to 4 months. So that is called an advance amount which you pay to the seller. So understand this advance as in future in the stock market. And another one is options. So token advance. Let me give an example with a token advance. So what happens when you're purchasing any flat? What you give a token advance to the flat owner, saying them, okay, you're selling this product, I will give you a token advance of this much percentage and I will buy this flat after 5 to 6 months. If at all I fail to buy this after 5 to 6 months, the premium which I paid, the seller will not give me back. So I have to pay the premium. That will be my maximum loss if at all I am giving a token advance. So what happens in future and options market, you are into an contract, you are into an agreement. Okay, but in cash market, you are not at all into any agreement. You are not into an agreement because you are paying the full margin, right? So there is no agreement needed in that. So but in future, in advance market, in token advance, you have to have an contract, right? Now let's assume due to some god grace, there is an metro station is coming, or there is an school is coming, or there is any mall is coming near your flat. So what happened in this case, the person A who paid in cash, he gets in 2 lakhs rupees as an increment due to that news. So due to that news, the flat price has moved towards the upside till 10% towards the upside. So the person A is getting 2 lakhs as in profit and the person B is getting 2 lakhs in profit, who is paid the amount for the flat as an advance. But the person who paid in token advance, he is also getting 2 lakhs rupees profit when the good news came and the real estate, I mean the flat price increased. So what you can understand from this is the person who is paying full amount, he is also getting 2 lakhs, and the person who paid in advance amount, he is also getting 2 lakhs. The person who is paying only small amount of premium as in token advance, he is also getting 2 lakhs. So now the what happens, the overall contract value, all of them, you can see it is 22 lakh for person A, and now the person B is having 6 lakhs and the person C is having 2 lakh 40,000. All of them are getting 2 lakhs rupees profit. But what happens in the negative aspect? You bought the plat for 20 lakhs rupees full margin, all the margin, sorry, excuse me. So what happened into the negative aspect? If at all the flat value decreases by 10%, in that case what happened? The person who paid full margin as in 18 lakhs rupees, he will lose 2 lakhs rupees, and the person B who paid in advance 4 lakhs rupees, he will lose 2 lakhs rupees. But the person C paid only 40,000 for the token amount. Now he says the flat value has decreased by 10%. Now I don't even want this flat. So what will be the loss for the token advance person? He will only lose 40,000 rupees only, not more than that. So now you understood the cash market is the the person A is a cash market person who buys the share for 20 lakhs rupees investment, so or 10 lakhs rupees investment. But the same person who's buying 20 lakhs worth of value of value, but he is paying only 20% of the whole contract value. It is called as a future market. But the person C who is paying into token advance, he is paying only the premium amount for that flat. So what does that mean? It is an options market. You have to understand like this. Okay, I hope this example helped you in order to understand cash market, future market and option market. Now let's get into the market terminologies which is used in the futures. Okay, when you go long, that means you are buying, because when in the financial market we don't say that I bought this, I sold this. Not like that. It doesn't work like this, because you're actually really not buying it, because in future market you're only having a contract. In reality you're not buying the physical shares, right? So that means you're only going long, you're going short, right? Long means buying, short means selling. Long position means I am holding buying position, short position means I am holding sell position. Open position means I am still having the position outstanding into my demat account, I have not closed it. Naked position means long or short position, which is naked, I'm not having anything else. If at all the market is going to go up, I'm going to make profit. If the market is going to go down, in short position, I'm going to make profit. Spread position, which means combination of two position. This spread position can be taken in option market, because in option market you have different types of strikes. Later we will speak about that as well. Calendar spread means combination of two position in different contract.